Ladies and gentlemen, good day and welcome to the Balaji Telefilms Limited Q2 FY26 earnings conference call. Before we begin the call, a short disclaimer. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in a listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanjay Trivedi from Group CEO and Group CFO from Balaji Telefilms Limited. Thank you, and over to you, sir.
Good afternoon, everyone, and thank you for joining us for Balaji Telefilms Limited's earnings conference call for the quarter and half year ended 30th September 2025. On call with us today, we have Dhaval, who is our Deputy CFO and Chief Strategy Officer, and Viren Trivedi, our Investor Relations team from Adfactors. I hope you had the chance to go through our financial results, press release and presentation shared on the exchanges and our website. It is a pleasure to connect with you all again. The first half of FY26 has been a period of steady execution, creative growth, and continued progress across all three of our key business verticals, that is digital, television, and motion pictures. Balaji Telefilms continues to stand tall as a veteran creative powerhouse in the Indian entertainment industry with a legacy that now spans over 3 decades. We have always believed in telling stories that connect deeply with audiences, and this philosophy continues to guide our journey, whether it's through television, films, or online content. Before getting into the business and financial performance, I would like to share some of the key recent updates and milestones. During the first half of FY26, we made solid headway in integrating operation costs post the merger of Alt and Marinating Films into Balaji Telefilms. We are gradually witnessing the benefits of this strategic move in the form of better cost efficiency, shared creative resources, and stronger IP leverage for the upcoming projects. Our long-term creative collaboration with Netflix is also progressing well, setting the tone for future content releases. Multiple projects are under development, covering wide spectrum of genres and audiences. We believe this partnership will set new benchmarks in storytelling and further cement Balaji's position in the OTT space. In November, we launched our premium astrology app, Astrovani, which offers a unique blend of technology and tradition, bringing the age-old wisdom of our Indian culture to the fingertips of the masses in an easy-to-use platform. This move is in line with our strategy to strengthen our digital offerings with scalable products. Earlier, we launched Balaji Studio, a specialized production division designed as a new generation content engine for the TV and digital platform across India. It is meant to serve as a creative ecosystem to foster emerging independent talents which can collaborate under one roof to create new and fresh ideas and concepts of storytelling. The studio has been envisioned as an agile, future-ready hub to capitalize on the rapidly evolving entertainment landscape. On the capital side, the funds raised last year amounting to rupees 131 crores will be deployed towards strengthening our movie and digital businesses. These investments are helping us build a deeper IP portfolio and new growth engines for the future. As is evident from the recent launches, we are increasing the thrust on our digital presence and new format content development to stay abreast with the overall industry evolution. Touching upon the business highlights in each of our verticals, first is the digital one. Our digital segment continues to be a strong growth driver and a key area of focus. Our OTT apps as well as YouTube channel have witnessed robust traction during this period. During the quarter, we had 93 shows live on our new app Cutting and 3 new YouTube original shows. These had over 400 million views since launch. Active subscribers stood at over 11 million. We are steadily transitioning to a hybrid SVOD plus AVOD model to broaden our reach, which is the B2C subscriber base and revenue mix. New plan options has also helped boost our subscriber base. In September, we launched Cutting, a family-friendly app for new short-form content streaming for the mobile-first audience. Cutting has been gaining early traction, while we are also strengthening our B2B digital business with various platforms with an order book of approximately 300 crores. Regional content partnership with ETV, AHA continue to expand our footprint and target audiences. These endeavors would be supported by our initiatives in the advertiser-funded programs, which is scaling up. In the television space, TV continues to be our creative anchor. We produced around 131 hours of program this quarter with 4 shows running. Despite some softness in broadcasters' budgets since some time, our hit shows continue to hold premium slots in prime time. We are also working on several fresh concepts that will reinforce our strong positions in the coming quarters. Movies. The movie business picked up momentum this quarter vis-a-vis previous sequential quarter. Our highly anticipated film Vrishubha is slated for its global theatrical release in December. The movie has been shot simultaneously in Malayalam and Telugu, with releases planned in Hindi and Kannada, thus catering to regional audiences. Moreover, Bhoot Bangla, featuring Akshay Kumar and directed by Priyadarshan, has wrapped up shooting and is now in post-production. 1. Our collaboration with TVF starring Siddharth Malhotra is currently under production. Overall, the content slate remains robust. As a result, we are following a de-risk approach, recovering about 85 to 90% of the cost through pre-sales and co-production agreements before release, ensuring stable returns and capital efficiency. Our growth strategy is balanced with efforts to strengthen the movie business, supported by the continued success of our TV operations. We are developing a diverse movie pipeline targeting both domestic and international markets, while maintaining a strong TV presence in prime time with a mix of new and existing shows. On the digital front, we are advancing initiatives such as the hybrid model, expanding our YouTube content and diversifying offerings to reach wider audiences. Now coming to the company's financial performance. In Quarter 2 FY26, revenue stood at 48.8 crores compared to 144 crores in the same quarter last year. The commission segment acquired for 77% of revenue, digital business is 13% and film accounted for 10% during the quarter. Loss before tax was 6.6 crores while loss after tax is 4.9 crores. EPS for the quarter stands at negative 0.40. For the first half of FY26, revenue was 121 crores versus 293 crores in the first half of last year. In this period, our commission contract segment contributed 68% to the top line, while digital, B2C and film contributed 27 and 5% respectively. Loss before tax for H1 FY26 was reported at 14 crores, while loss after tax for the period stood at 10 crores. EPS for the 6 months was 0.89 negative. If we look at the result of the previous 3 quarters, there has been sequential business EBITDA improvement from earlier quarters, from Quarter 4 FY25 to Quarter 2 FY26, from a negative of 8.8 crores to a negative of 4.3 crores. The stress in the results is largely due to the mature TV series coming to an end. 3 shows ended during the quarter. Pariniti concluded on 1,216 episodes on Colors, ended in August 25. Bade Achhe Lagte Hain फिर से ended at 70 episodes. Kumkum Bhagya, we concluded at 3,192 episodes on Z. This situation occurs once in every 3 to 5 years, and we are currently rebuilding the pipeline for the future. However, this segment will remain under pressure due to lower yield from broadcasters. Our cash reserves remain strong at 137 crore, providing comfortable liquidity for our growth plans. The company will focus on investing in IP-led businesses, primarily in movies and digital space. Moreover, our order book for our digital B2B business stands at approximately rupees 300 crores with various leading OTT platforms. Looking ahead, we remain focused on scaling our movie and digital businesses while maintaining our leadership in television. Moves such as the new app launches, Cutting and Astovani are initiatives in that direction. At the same time, the newly launched Balaji Studio will boost next generation content creation. With a robust content slate, expanding partnership and the operational efficiencies gained post the merger, we are confident of driving consistent profitable growth. The entertainment landscape is evolving rapidly, and Balaji Telefilms is well positioned to lead this transformation with creativity, agility and innovation. That is all from our side, and we can now open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Harshit Karga from Robo Capital. Please go ahead.
Hello, am I audible?
Yes.
Yeah.
Yes, sir. Thanks for the opportunity. So I wanted to ask that AI is now able to create good quality videos. So how do you see this affecting your business?
So AI is enabling information technology advancement which we have seen over a period of years. So this is one of those many things which will help us in creating good content, save some cost, and maybe speed up the process of creating content. So for us, it is a plus.
All right, sir. So you are using AI tools right now to cut down your costs?
Yeah, absolutely. Not only for the from the overall operational efficiencies, we are also using extensively in our shows, which is largely on the digital space, on the cutting app. We have AI created content also onto that.
All right, sir. Got it. Thank you.
Thank you.
Thank you. The next question is from the line of Sneha, an individual investor. Please go ahead.
Thank you for taking my question. My question was regarding our profitability and revenue dip. So we have seen that all our three divisions have not performed quite well. So can I know the reason and how we are going to do it better in the coming quarters?
No. So, ma'am, if we recollect when we have done the last conference call, we had clearly stated that this year is a year where we are working on creating pipeline for the motion pictures business. So, our first big release happens in April of next year. So, from that quarter onward, you will see an upside into all the segments. Okay, that is one. Two, on the TV side, lot of mature TV serials got ended in this quarter. As a result, you are seeing a dip in the programming hours. But that's a process. Every time in 3 to 5 years, you come to a stage where 3 or 4 shows goes off air and then you rebuild the pipeline. But that's the nature of the business we are in. Having said that, TV business episodic revenue will continue to be under little pressure because broadcast is also looking at cutting cost, and the content cost has been reduced drastically by the leading broadcasts. So unless somebody comes up and take the punt of, kind of investing heavily into this content, we will continue to be in the range of 24-25 lakhs per hour episodic revenue. So that's one. And on the digital side, ma'am, we merged the digital entity into Balaji Telefilms for the tax and operational efficiency also. And now, as we speak, every quarter we are adding order book to the B2B digital space which we have. So currently we have 250 crores plus order book with Netflix, 42 crores order book with Z Studios. And there are others with Amazon, Sony and Star. So we are developing this pipeline. The benefits of this pipeline will come only from the next financial year. So this year will remain more or less what we are seeing now. Even quarter 3 and quarter 4 will remain muted to that extent. And quarter 1 from the next financial year, you will see a clear upside and the numbers which you are looking for.
Okay, understood. And
we will have close to 4 movie releases minimum in next financial year, and all are big budget movies.
Okay.
And we have pre-sold, so we are sitting pretty on the revenue side also.
Okay. And the contribution from these three...
The Akshay Kumar Priyadarshan movie called Bhoot Bangla, whatever is the cost, I have fully pre-sold and recovered. So whatever comes from theater will be a profit.
Okay. Okay.
Yeah.
And the contribution from all these three segments will be different from what we can see now?
So as I see going forward, I think motion pictures will be the biggest contributor to the revenue and profitability, followed by digital and then TV. But this is saying, I am saying in 3 years space, maybe next year you will still feel, you will see the number like motion pictures will drive this thing, then it will be followed by TV and then digital. But by end of 3 year, I think TV will be the 25% contribution to the revenue and the top profitability.
Okay, understood. And just a last question on the astrology app. So what was the motive of launching that app in this quarter, and like how is it going to
So
help
if
us?
you would have seen our app called Alt was
Yes.
banned by the MIB. So
Yes.
for those 45 days, 60 days, the app was not live in India, though it was operational globally. We had our infrastructure ready. There was no incidental or incremental cost attached to doing any other thing. So we launched the new friendly app called Cutting, and alongside we launched Astrovani, which we clearly see as a low cost but very efficient mass content consumption. And here there is no outlay, there is no capital outlay upfront. I am using the existing infrastructure space which we had for the Alt or now for Cutting. So there is no incremental cost to run this app.
Okay, understood. Thank you. Thank you for taking my question.
Thank you. The next question is from the line of Sana M, an individual investor. Please go ahead.
Good evening, sir. Thank you for the opportunity. I have two questions, sir. The first is, are there plans to build a broad consumer ecosystem around the new
Sorry to interrupt. Your voice is not clear.
You are not clearly audible.
Hello, am I audible now?
No.
Hello.
Yeah.
Good evening, sir. Am I audible to you?
Yeah, this is better. Yeah.
Sir, thank you for the opportunity. I have two questions. The first is, are there any plans to build a broader consumer tech ecosystem around the new app, similar to what other media houses are creating with the digital community? And the next question is, how does management prioritizes capital allocation between content creation and new digital product launches?
So in terms of capital outlay, first I will answer it.
Okay.
So whatever new initiatives we have taken, apart from maintenance capex, we don't expect anything huge capital outlay into this space. The total capital, if you ask me, 150 to 175 crores will be into motion pictures. Television doesn't need any capital, so it is totally funded through internal accrual. On digital space, close to 20 to 25 crores working capital is needed for us. Hello?
Okay. Yes, sir. Sure. Hello?
Anything else?
No, sir, that's all from my side. Thank you.
Okay. Thank you. Thank you.
Thank you. The next question is from the line of Parth Chauhan from Patel Investments. Please go ahead.
Good evening, sir. Am I audible?
Yeah, sir.
Yes, thank you. Thank you for the opportunity. I had a couple of account-related questions. So, following up on the previous man's question on the astrology app, so I consider that is going to be a segregation from our core business. So, will you still consider is that the revenue from operations or will it income?
So it will continue to be revenue from operations. It is not a non-core. We are into digital space. This is one of the digital offering to the masses.
Okay. And so moving forward, what kind of revenues are we expecting and margins as well?
Hello, good evening. Dhaval Sheth here, the Deputy CFO. I'll take that question. So for the Astro Money by Balaji app, we saw this white space, like Sanjay sir said that We have our own team ready to deploy this app. So, we have just started. We launched it on November 7th, the first phase of the app. We are having a couple of more phases. We build the entire app and keep updating. For the first full year, the kind of projections we have with respect to this app is that we anticipate this app to accrue a top line of somewhere INR 5 crore rupees. So that is the kind of top line we are looking at with the capex of what the internal teams we have. So we need to look at the first full year as more investment, and then we see the scalability and scale in the subsequent years.
And there are three phases in which this app will be kind of upgraded and scaled up. So we have to see those three phases, and then we go into kind of growth phase in that market.
Got it, sir. And secondly, if you look at the accounts, there is 55 crores worth of inventory added between September and March. So I just wanted to know what is it regarding?
So basically, if you see the way Indian accounting standard permits, the moment you sign an artist or talent or for any other purposes, if you do a movie, it goes as advance. It moves into inventory when you go on a floor, or when you start the shoot, then the inventory, all these advances moves into inventory. Okay. Now, the surge in the inventory which you are seeing is largely because of the motion pictures, where we have Bhoot Bangla, Vrishubha, and One. These three movies on floor, and hence you can see the surge in this coming quarter, rather in last quarter. If you see, even advances would have gone up.
Yeah. Okay, sir, that answers my question. Thank you so much, and all the very best for the future.
Thank you, sir.
Thank you. The next question is from the line of Vikrant Sahu from AK Advisors. Please go ahead.
Good afternoon, sir. Thank you for this opportunity. I just have few questions. Could you throw some light on the opportunity size we see in Balaji Studio? How is it different from the existing production house?
So Balaji Studio, currently if you just see it, Balaji Telefilms is largely the content is created by the genius which we have, which is Ekta Kapoor. Going forward, we want to kind of have another vertical where we, like a studio, we work with the other creative people and has these shows which doesn't consume Ekta's bandwidth. So this is add-on to what we are doing.
And also, we have new launches, new app launches like Astrovani and Cutting. So, what kind of revenue and profitability we are expecting for?
In the previous conversation, Dhaval addressed this question.
Oh, okay, got it. I'll check.
Yeah.
Okay, that's it, sir, from my end.
Thank you.
Thank you. The next question is from the line of Nimish Pandya, an individual investor. Please go ahead.
Hello, am I audible?
Sir, can you speak a little louder, please?
Hello, am I audible right now?
Yes, sir. Go ahead, please.
Maybe you are a little far away from your telephone or cell phone.
Now, is this fine now?
Yeah, this is fine, yeah.
Okay. Congratulations, sir.
Thank you.
So, I have a couple of questions.
Yeah.
So my first question is, what are your views on how the TV business and industry as a whole is going to pan out over the next few years?
Okay. Should I address that first?
Yes, please, sir.
So, the linear TV continues to be on a decline. Okay, that you can see even from the broadcasts which are listed like Zee and everybody. That decline is quite visible. I am not saying TV is going to die, but connected TV will be a play. So there will be, for us who are content creator, it doesn't make much of difference, because whether I'm giving content on a linear TV or either I am giving on a connected TV. So that's why you see this surge of 350 crores of order book which we are talking about is coming
Yes.
primarily from this OTT space. So going forward, I think the way you should be evaluating Balaji is broadcast plus OTT content. That this will be a commission model which we should be looking at. So whatever decline you are seeing in TV will be compensated or rather will be more than compensated by the growth in the OTT content business.
Got it, sir. Understood.
So my have just moved from TV to connected TV.
Got it, sir. Absolutely. Sir, what is our...
It's evolving. So from a short format shows to a long format show to a binge viewing. So they are still kind of experimenting. And I think we will take few years to come to a clear strategy on that.
Got it, sir. So, sir, what is our strategy for talent acquisition when generating new content? Talent acquisition.
So we are not into talent management space at all. We are
sir,
content.
while generating new content, sir.
Sorry?
While generating new content.
So we hire talent for the content whenever we need them. No? They are not on payroll. We are not contractually signing anybody with an MG. Nothing like that.
Okay. Understood, sir. Sir, I have one more question. It's related to, sir, what is the ARPU trend and how is the mix between monthly and annual plans shifted? Can you shed some light on this?
So I would say 90% of the subscription revenue is still with the lowest pack.
Okay.
Yeah, that's across spectrum. So we are not new to this. This is how Indian consumers prefer. They pay for the lowest one, and then if they like something, they keep renewing it.
Got it, sir.
Global subscriber, they prefer annual package. So that's the qualitative difference which we have seen.
Absolutely, sir. Sir, can you shed some light on guidance for full year, like top line and profitability?
We generally don't give any guidance or a forward-looking statement. But what I can tell you is whatever you have seen in quarter 1 and quarter 2, I think we will remain more or less in the same zone when we end this year.
So, okay. So I have one more question if I may ask.
Yeah.
So how is, sir, the user engagement, the watch time per user, or the churn rate trending compared to the previous quarters?
So I would say the churn rate is still pretty high. From 65 to 70% churn rate happens on SVOD platform.
Okay.
And if you see the engagement, it all depends on how many shows you are logging onto your platform or your YouTube channel or any other channel. The moment you drop a new episode, you see a surge there, and then it gets stabilized. So you have to keep kind of engage the consumers with more and more content and hope they watch it and they like it and they sample it.
Understood. Sir, and also one more question. What is the average cost per show means, and how has content production cost trended year on year?
For TV?
Yeah, for TV.
For TV, so I just gave a rationale that we were at close to around 28 to 29 lakhs per hour episodic revenue for television.
Got it.
And that's the revenue side. And close to 30% is what you make it on direct variable cost level. So that's the margin which you make. Yeah.
Got it, sir. So one last question, sir. So what is the current paid subscriber base and what was the net addition during the quarter?
So that's what we are saying. In last quarter, for almost 45 to 50 days, our app was banned by MIB. So we had started cutting. We had to start from base 0. So we're gradually building it. Those subscribers are getting migrated to this new platform. And quarter 3 will be the period in which you will see the similar range, which will be around 40 to 50,000 active subs at any given point of time.
Understood, sir. Thank you, sir. Thanks. That's it from my side.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Muskan Malhotra from an individual investor. Please go ahead.
Hi, sir. Thanks for this opportunity. I have two questions. Hope I'm audible.
Yeah.
Okay. So what are the utilization plans for the cash reserves? And my second question is that what are the tangible impacts of the recent mergers that have happened?
Okay. So we raised 131 crores, and the purpose for those utilization proceeds are clearly out there in the list which we have published to the stock exchanges. So primarily 65 crores will go into motion pictures, 33 crores will go into music rights, movie distribution, digital content space, and general corporate purposes is 32.5. As of now, we have not used a single rupee from this fund. And your second question, what was your second question?
It's around tangible impacts of the recent mergers that have happened.
So on the merger side, apart from this operational efficiency and the kind of trimming down of overlapping costs, there is a clear, distinct tax advantage which the holding company will benefit. We have close to 117 crore of GST input credit which is available. So that gets used. So it will help us conserve more cash onto the balance sheet. And we have over 100 crores of brought forward losses. So our PBT and PAT will remain same, as there will be no incidence of tax for the next 4 to 5 years.
All right, sir. That was very helpful. Thank you so much, and all the very best.
Thanks, ma'am. Thank you.
Thank you. The next question is from the line of Yashika from Mirza Enterprises. Please go ahead.
Hello, am I audible?
Yeah.
Yeah, thanks for the opportunity, sir. So I just wanted to gain some light upon the cutting app that you had mentioned previously. Just a couple of questions around it. Like, what is the primary target audience that the cutting is basically designed for? And what tiers are you basically targeting? And is it focusing on the Gen Zs or the millennials, or as a, family concentrated one? Plus, what's the average duration of the dramas you're presenting, and what's the long-term vision of the app that you have, launched basically?
That's tons and loads of questions which you have asked in one statement. Okay. So I will just give in a very simple way to make you understand how we operate cutting. Cutting is primarily for a content which is sought by the masses. So it is not meant for, it's not for Netflix audiences. So it is meant for masses, and it has all the genre and kind of content and the method in which they want to watch. They can go for binge viewing. There is episodic drop of content. Then there is a vertical format, and there is AI-led content, and so on and so forth. So, and we have just launched it only at the end of the quarter. Hopefully it will all play out the way we wanted, like what we did with Alt. But it is more family oriented rather than, it will not be having the edgy content, which probably was a little overhang onto our brand.
Okay, so that was helpful. So thank you so much.
Yeah.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. As there are no further questions from the participants, I would now hand the conference over to Mr. Sanjay for the closing comments. Over to you, sir.
I would like to thank all of you taking the time to join us today. We remain committed to deliver top quality content across all our platforms and leverage our strength to make strides in new growth avenues. Our overarching strategy is aligned with this long-term objective while generating sustainable value for all stakeholders. For any further queries, please feel free to get in touch with Adfactors, our investor relationships team. Thank you.
Thank you. On behalf of Balaji Telefilms Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.